You own real estate and are considering selling it, but doing a tax-deferred exchange into another property isn't desired. Or you're selling your company, and after you pay the state and federal capital gains taxes, you'll have about half of what the buyer paid, and not enough to provide you the income stream to support your desired lifestyle. What if you could sell either asset for cash and postpone recognizing the gain on the sale for 20 to 25 years? Meet the Section 453 installment sale and the non-grantor trust. Internal Code Section 453E allows the taxpayer to sell a capital asset at a profit, receive a long-term or promissory note, say 20 to 25 years, receiving interest only, and defer the capital gains tax allowing the full amount versus the net after-tax amount of the sales proceeds to be invested. When the promissory note comes due and repaid 25 years hence, that's when the capital gains tax is due. In the meantime, you can invest 100% of your sales proceeds, generating significantly larger returns on your investment. How does it work? You, as the seller, establish an irrevocable non-grantor trust, treated as a separate taxpayer for income tax purposes. You sell your appreciated asset to the trust for a long-term promissory note at interest only. The non-grantor's tax basis is equal to that which it paid for the asset. As the cash basis seller, you only recognize the gain when the note is repaid. Say you sell an asset valued at $5 million with a cost basis of $1 million to the non-grantor trust and receive a $5 million 25-year interest-only promissory note with an interest rate as low as the long-term applicable federal rate or higher if the seller needs more cash flow. If the non-grantor trust holds the property for at least 24 months and 1 day before selling it to a third-party cash buyer, the trust's tax basis is equal to the purchase price paid for the asset. The capital gains are computed by the trust on net sales proceeds less the trust's cost basis. You, the original seller to the trust, continue to defer the gain until the note is repaid 23 years hence. The trust's cost basis is $5 million. After satisfying the 2-year holding period, the trust sells the asset for $6 million, reporting only a $1 million immediate long-term capital gain and paying, say, $250,000 income tax on that gain. The trust now has $5,750,000 in cash proceeds to invest for the next 23 years before the note is repaid and the taxes are due by the original seller. So, by the time the note is repaid, the invested proceeds might grow by 4 or 5 times, depending on the success of the trustee's investments. All legal and sanctioned by the safe harbor provisions of the Internal Revenue Code. Add it up, and that is why a non-grantor trust could be just the right capital gains deferral strategy for you.
Hi, I'm Michael Wallace. I'm CEO and founder of Wallace Investments. We specialize in implementation of tax strategies to save money on your taxes every year. Probably have more tax strategies than anyone else. We have a specialized program where we can actually prepare your tax return and implement our specialized tax strategies free of charge. If you're interested, see my contact information. Thank you.